Hello, traders. FX Pep Collector here. How's everybody doing today? So today is Wednesday and it is June 18th. So how is everybody doing today? Today's kind of a big day. This is really the only time I'm still live streaming on YouTube. I do most of my live streams for only my premium members a couple times a week. But I definitely do like to live stream for the FOMC because it can be pretty interesting, definitely. So in 30 minutes from now, 29 minutes from now actually, in 29 minutes, we're gonna have probably one of the bigger news events of the quarter. They are definitely not planning on lowering interest rates, and if they don't lower interest rates, it possibly will not be that big of a move in the market. If they do end up lowering rates, then that's when we're going to see a big dramatic move. I kind of hope that they do end up lowering rates at least 25 basis points. Many other countries have definitely been doing it. And then about 30 minutes after that, which is about an hour from now, we got Powell speaking, and hopefully Powell says something good tonight. Normally during the press conference is when you get the big giant moves. You're going to get an initial move right at the news, and then when Powell is talking is when you're likely to get another pretty good move. Sometimes like a spike reversal, sometimes just a continuation pattern. So, anyways, yeah, we got about 28 minutes now until the news comes out, and then we got almost an hour until Powell starts talking. I got the Powell speech all queued up so we can see what he has to say when the time comes. It starts in 57 minutes, and we'll stick around for that. If you haven't done so yet, definitely do check out my Discord channel. My Discord channel is definitely 100% free to join. You do not ever have to pay a dime if you do not want to. So definitely check that out. The link for that is in the chats of this, and it's also in the description. So, anyways, definitely check that out, and definitely don't forget to check out my website if you're interested in that. But, anyways, let's get to the charts. I just recently spent quite a bit of time working on the US dollar index analysis because, obviously, for me personally, the US dollar index or the DXY, whatever you prefer, is definitely your main analysis to help you trade all the dollar pairs except for maybe gold. Gold doesn't really follow the dollar index like most of the other dollar pairs do, and the dollar yen doesn't always follow the dollar index either because sometimes it's the yen driving that more than anything. But definitely our six main pairs right here. A main driver for that is the US dollar analysis. So if you can figure out what the US dollar is doing, you can kind of figure out where every single one of these pairs are doing, except for potentially gold, because gold kind of does whatever gold wants to do. But anyways, we are definitely very obviously at a very important support area right here, as you can see. I mean, this thing's bottomed out many, many times right here already. So definitely a major support area. This is the fourth time it's tested this area, maybe even the fifth time. But most of the time, if you get an area tested more than three times, most of the time you are going to end up seeing a breakout. You can test an area three times and then it just keeps on going up. But if it keeps testing that same area more than three times, kind of the rule of thumb is that it will end up breaking that low, which lines up with our analysis really well, or at least with me and my group's analysis, because we are expecting that we're in a wave C. I think this wave C is potentially going to go down to the 61% because that's also the 100% Fibonacci extension. So you take the Fibonacci extension tool down here and you measure the potential wave A. You project it off the top of this correction right here, which is the potential wave B, and that gives you the 100% Fibonacci extension for wave C. And it just happens to line up really well with the 61.8% Fibonacci retracement of this whole last impulsive move up. So I think it makes sense for the dollar to continue down overall. I still think it has quite a ways down. And if you're talking about the DXY, which I don't really cover the DXY much, I think the DXY has the potential to go down to maybe, I don't know, maybe, like I said, I don't really analyze this one, but I think it still has a lot of down potential, maybe even the 95 area or something like that. So that pretty much gives you the main direction for all these US dollar pairs, at least on the higher time frames it does, in my opinion, which I think is an expanding flat. If you're talking about the euro, I think it's an expanding flat if you're talking about the pound dollar. The Aussie dollar should be a WXY on the higher time frames. Kiwi dollar should be a WXY on the higher time frames. US dollar index should potentially be a wave Y on the higher time frames, going down in three big waves. And the US dollar Swiss, I'm targeting either the 78 or the 88%. I mean, that doesn't mean we couldn't possibly get another push up. It just means that overall, I think the higher time frame trends are going to continue because of our US dollar analysis. Now, that potentially doesn't mean that we couldn't be bullish the US dollar for a while, right? I mean, we definitely could be bullish the US dollar. So, like I said, before the live stream started, I spent a good amount of time working on my 4 hour time frame analysis for the US dollar index. One thing that my mentor used to always teach us is that you just need to really look for where's an impulsive five waves and where do you see corrective three-wave patterns. Because if you can identify five-wave patterns, then usually they're followed by three-wave patterns, followed by another five-wave pattern for either an ABC or potentially a one, two, three. So that's really all the key is to Elliott wave. I mean, who cares about everything else? So we definitely have a five up, three down, and five up. So that's definitely an ABC. And then we have one, two, three, four, five down. So that's five ways down. That's an impulsive move. And then this is definitely five ways up too. So this is five ways up right here. So you have a corrective impulsive move down five waves, and then you have five waves that go up and take out the high wave four. That is telling you that you're almost definitely looking at a wave A. So more than likely that is a wave A. So if it's a wave A, that means that this low down here would potentially have to be a wave B, right? This is stuff I talk about in my live streams a lot that I do for my members. It's kind of more advanced Elliott wave, but if you have a four get broken, and then you have a five, well, I should probably switch to yellow, and then you have a five-wave pattern down, a three-wave counter pattern, and then another five-wave pattern down to the 123, 138, or 105 level, which is the Fibonacci retracement with added on, 105, 123, 138. If you get a turn at one of those three levels with a 535 pattern after you get an impulsive 5 up that breaks the high of wave 4, then you're almost definitely looking at a flat. And if that's true, which it definitely fits the characteristics, then potentially we should be going to a Fibonacci extension of wave A. Whoops, that's not Fibonacci extension. And this is really important because it tells us literally what to do on every single dollar pair, like I said. So my target for a running ABC, because if it's a 123 turn like it is, my target for a running ABC would probably be 100% of wave A, which would be a lower high because this is a expanding ABC right here. So your target for a running ABC would be the 100% Fibonacci extension of wave A, projected out the bottom of wave B, possibly one, two, three, four, five waves up, and then reversal back down. Or if it's an expanding ABC, which it definitely could be, then my target would be the 178, 161.8, and that would still probably give us a one, two, three, four, five wave pattern to the upside. So this is my analysis on the US dollar index over the next week or so because this is the 4 hour time frame. I think we're potentially going to go up in a five-wave move to the upside for like a wave C of either a running ABC, 100% area, or an expanding ABC. So if this is going to go up for the next week or so, then that tells me literally what I should be doing on every single one of these dollars pairs, except for maybe the US dollar yen and except for maybe gold. So it's pretty important that you understand what the dollar index is doing, and this is why I analyze the dollar index beside over the DXY, because the DXY is literally a mirror image of the euro dollar, so it doesn't really help that much. So because of that analysis, I know pretty much likely what's going to happen on all these pairs. We're probably in the middle of an impulsive move to the downside, like a wave one, two, three, four, five, maybe go down, take out all these lows, and then potentially back up like that. So that's what I think is going on there. I think the same thing on the pound dollar. I think we're probably in the middle of a little bit of a bigger move on the pound dollar, but I don't know. The dollar index really makes me think that these moves aren't over. Most of this impulsive move that we see down is because of the pound news that we had yesterday, this morning or whatever. Yeah, this morning. So a lot of that is because of that. So this potentially could go down quite a bit more. Maybe do something like this. So because I'm bullish the dollar index, I should potentially be bearish all these pairs. The question is whether it's going to do like a liquidity grab at the news or not. So because I'm bullish that, I should be bearish every single one of these dollar pairs. Like I said, whether it goes up and does a liquidity grab or not at the news is kind of the question. Because I'm bullish the dollar index, I should potentially be at least somewhat bearish the dollar CAD, probably something like that, maybe a little more. And the dollar Swiss, same type of thing. I should potentially be bearish the dollar Swiss because I'm bullish the dollar index. So, like I said, that kind of gives me everything, my plan right across the board for all the dollar pairs is spending most of my time analyzing the dollar index. So the question is whether it's going to do a liquidity grab or something first. Maybe spike up and then down or something like that. I don't know. We'll see. Most of the time, you do get some pretty good liquidity grabs though. These news events. It almost looks like on the 1 hour time frame, it could be a wave one, two, three, four, five, and then it could reverse back up. So we'll have to see what happens. These things can be a little unpredictable for sure. Let's see. Let's see if you. So yeah. Anyways, oh yeah. I mean, we'll see. I mean, I definitely could picture this being an ABC. That's been my analysis for the last few days. So I mean, if it does look like a one, two, three, four, five. So if I see this thing go out, take out these lows, and start to reverse back up, I might take it as a long, definitely. So we'll see what happens. If it just shoots down, then obviously not. But this potentially could be like some sort of a ABC too. I was looking at, this potentially could be one, two, three waves up. This is your wave A. This is your wave B. Now we have a wave one, two, three, four, five. It goes down, takes out the lows, and then reverses back up for the continuation of the higher time frame uptrend. So that definitely is pretty possible for sure. And gold, boy, gold has been kind of a tough one. I have multiple scenarios for gold on the higher time frames. My main analysis is still that it kind of looks like a WXY on the daily to 4 hour time frame. It looks like impulsive down, three waves, impulsive down for three waves of W, and then impulsive up, one, two, three, running ABC for the wave B, and then back up for an ABC of X. It seems like we potentially should be going down for five waves down, three waves up, and then five waves down for a 5-3-5 pattern. This has been my main analysis for about a week or so on gold. 5-3-5, take out the lows. This is all wave four of wave three. So this is a wave three. This is a wave four of wave three. And then potentially it goes up for wave five of wave three. So that's my main analysis for sure. But the problem is that it still hasn't even made an engulfing move down. And the other big problem is that the monthly is very clearly in an uptrend with no proof that it's over. The weekly is very clearly in an uptrend with no proof whatsoever it's over. There's no break of structure. There's not even an engulfing move. There hasn't even been an engulfing move to the downside on the weekly time frame. All this little price action is all within the last bullish candle. So like there's no engulfing down, there's no lower high, there's no break of structure. I mean, this thing possibly could just keep on going up pretty easily. So we'll see what happens there. And then you go down to the daily time frame, and this potentially could be an ABC, and now we could just be trending up. I usually don't trade gold on the sort of time frames. I mean, I will take like more of a try to take more of a swing trade on gold sometimes, but yeah, so I potentially think we should be going down for five waves down. It kind of seems like it should be a wave one, wave two, three, four, five waves down for the A of wave Y. Seems like it should go up and take out these highs, just like I said this morning in my morning video. Seems like it should go up there, take out these highs, finish off like a wave two, and then go down for a wave three, wave four, and then eventually wave five over the next few days for a wave A of wave Y of wave four. And yeah, the US dollar yen, the dollar yen is definitely different than the other dollar pairs for sure. And the reason why it's different than all the other dollar pairs is because the dollar yen gets driven by the yen pairs almost more than it does the dollar pairs sometimes. If you compare the dollar yen to the other yen pairs, you can see that the yen definitely is a main driver of the dollar yen. So it definitely makes it a little bit different than the other dollar pairs as far as direction is concerned. But what I've been saying in my videos is definitely still applies. I mean, it looks like impulsive down. It looks like impulsive up. It looks like three waves down. It looks like we're in the middle of an impulsive wave C, maybe to 60 or to 71%, and then potentially down again. Now, if it broke structure on the sort of time phase, like I said this morning, then that would potentially invalidate my analysis, right? So if this breaks this low right here, this is the US dollar yen right now that we're looking at. So if it breaks this low right here, potentially that's going to invalidate this wave C analysis. Which, as an Elliott wave trader, you have to be not married to your analysis. You need to be willing to change it. The market is the only one that knows best. So if it takes out this low, then that kind of invalidates my wave C, and potentially it's just going to keep on going down on the longer time frames. If it makes a higher low, it potentially is just going to keep on trending up. It did go down pretty strong today, but did it take out any structure? Definitely not, right? It's all relative to what time frame you're trying to trade. Because if you are a scalper, then yeah, the 30-minute, 1 hour time frame broke structure last night in the Asian session. After that break of structure right there, if I was trading like the 5-minute, 1 minute time frame, I would have been looking for shorts if I was trading the very short time frames. But at the exact same time, if you're if you're more like a 1 hour time frame to 2 hour time frame trader, then you're probably still sitting here saying, okay, well, if it takes out that low, I'll start looking for shorts. If it bounces from a fib level, makes it a golfy move up, then potentially I'll keep going long because the trend is definitely up, right? Look at this. Higher high, higher low, higher high. It did break, but it only spiked. So really, higher high, higher low, higher high. This could make a higher low. It could go make a higher high, a higher low. Yeah, I definitely focused on the dollar pairs. Somebody wanted me to look at the NASDAQ, which I just made a video for that. That's why I wasn't really listening for it, but I could definitely check out the NASDAQ real quick before the news comes out. If you saw my video, I literally just made a video for this afternoon, but I definitely think we're in a wave five right now. I think we had a steep ABC correction for the wave four. Either that or it's more of an expanding ABC on like the weekly. And then potentially this is a wave one, wave two, wave three, maybe a wave four. And now we're likely in like an ending diagonal wave five right now. Most wave fives do take out the highs, so I think it's going to go up and take out the highs. I'm definitely still bullish on NASDAQ. Going down to the 4 hour time frame, this is where it looks to me like an ending diagonal. It looks like a big impulsive up, corrective down, smaller impulsive up, corrective, 1, 2, 3 pattern. This would lead to another impulsive move up that takes out the previous highs. So my analysis from this afternoon on this, if definitely it still applies. If you haven't done so already, if you join my free Discord channel, which is 100% free to join, you never have to pay a dime if you do not want to. And you go to where it says videos, you can see where my upcoming live streams are. You can just check that out. And you can also see my video schedule. You can see what videos come out and you can see what time the videos come out every single day. I do these short videos every single day and then I do a full top down analysis for Sunday. So definitely check that out if you haven't done so. I mean, it is 100% free to join. You never do have to pay a dime. Really, the goal is to build a community of traders that are like-minded and that really just want to help each other out for free. No spamming, no scamming, nothing like that. So definitely check that out if you haven't done so already. It is 100% free to join, as always. The link for that is in the chats on YouTube and it's in the description of the video. So, anyways, yeah, I mean, I would be overall bullish on the NASDAQ, definitely. Yo, dollar. Like I said, man, I might end up getting suckered into a log on this tonight. I don't know. We'll see. If this thing goes down, like I was just saying, if it goes down, takes out these lows, and then looks like it's starting to spike reverse, I'm gonna go long for sure. But I also could see the possibility of this thing making a bigger turn on the higher time phase. But I feel like the trend is still up on the daily, so there's a pretty good chance this thing doesn't stop here. There's a pretty good chance that it just keeps going. Definitely looks like a 5-3-5 pattern, doesn't it? 1, 2, 3, 4, 5. 1, 2, 3. 1, 2, 3, 4, 5. Sometimes when I see patterns that look so extremely clear as far as Elliott Wave is concerned, it's a little concerning because obviously the big money traders know all these strategies. They know Elliott Wave and all that stuff. Sometimes when you see these perfect patterns during these news events, it doesn't end up playing out like you think it would. So that's a little concerning. But boy, that looks like a pizza perfect 5-3-5 pattern ABC. Definitely looks perfect. It looks almost too perfect. That's why I'm a little concerned about it. So we'll see what happens. I could definitely picture some of these making a much bigger pullback, like a wave two pullback on the daily. So yeah, I just looked at NASDAQ. We can look at other stuff after the. So the news is going to come out in 10 minutes, right? So we got news in 10 minutes, interest rate news. And then we're going to have 30 minutes in between the interest rate news and the Powell speech starting. The Powell speech starts 30 minutes after the news. So we'll have 30 minutes to take requests. So if anybody who wants me to look at something in between these 30 minutes, that's when we're going to take requests from people in the chats. I'll look at anything. I can look at crypto. I can look at indices, individual stocks, pretty much anything I can look at least give you my opinion. But boy, the pound dollar also, I mean, I don't have it labeled like this, but today when I was looking at my charts, I really noticed a pattern that potentially is sticking out, which is five waves down, five waves up, three waves down, five waves up, and then one, two, three, four, five down, take out the lows, and then continue the uptrend. Really seems like it's a ABC correction within a big uptrend on the higher time frames. Yeah, I mean, I just worked on Bitcoin a little bit. I could take a real quick look at it. I was just working on Bitcoin because I do make a video for it, like twice a week. So to me, Bitcoin made a big impulsive move up on the daily, and then it also made five ways down. So I think we're potentially in a 5-3-5 pattern on the daily, which is likely a wave B, which will probably bring us back up towards these highs, and then back down to maybe, I don't know. I'd have to put a Fibonacci extension on there after it goes down, but probably someplace around the 95 area or something like that for an ABC. Oh, you missed my NASDAQ? I can definitely look at it again after the news comes out. We got news in a few minutes. I'm bullish the NASDAQ. I'm looking for longs on the NASDAQ. Definitely. I still think it's in a wave five, just like I was saying in my video today. So, anyways, take this down to, which I don't want to spend too much time on this because we're about to have news, but it really looks like a potential wave A, wave B. Yeah, manually put these labels on there. I've tried a couple of those Elliott wave indicators or whatever they're called, and they really do not work very well at all. They're constantly repainting their analysis, which you kind of have to do anyways as an Elliott wave trader, but they're constantly changing things and stuff like that. So it's definitely, you're better off to learn how to do it on your own. It's really not that complicated. Takes maybe a few years to really get fully the hang of it, but most of it is tuning the frequency of your charts anyways, which is the secret to Elliott wave, which is probably the most difficult part to Elliott wave. So yeah, let's see here. We got 6.5 minutes roughly until news comes out. But anyways, I think Bitcoin is potentially getting ready to go up for a wave C and wave B, probably back up towards the 110,000 area, and then potentially down for a bigger wave C. Obviously not that clean. No, it's going to be obviously waves to the downside, but something like that, definitely. So that's that. I think there's a good chance that the dollar could spike down too. It looks like one of the guys in my chats was saying that too. I think it's going to go short, but then I think it's going to go potentially long afterwards. I don't know. I can see this correction not being over yet too. The euro dollar has always been my main pair. That's always the pair that I mainly trade. What? Yeah, I don't know. That correction is definitely about the same size as this one, so it should be a 1, 2, 3, 4, 5 spike reversal potentially. Looks like it needs to go down, finish off a wave five, take out everybody's stops, and then go up again. I think gold potentially could go up a little. I don't know. Like I said, I have two possibilities on gold, but I think someplace inside here we have an ABC correction. Is potentially a wave one, wave two, like I was saying earlier. I think gold potentially could go up and take out all these highs, maybe even this high, and then maybe tomorrow or something start to move to the downside for wave three. So that's what I think on gold. Overall, I'm still bullish the dollar again. Like I said, I mean, especially if this holds that 78% fib, we'll see. Kind of seems like the dollar Swiss isn't really ready to go down yet, though. I was just saying the dollar index might go up, so this thing might just potentially keep going up. Uh, so let's see here. Got about 5 minutes, 4 minutes until the news. Boy, all these pairs really look like they need to make a wave five. Maybe grab some liquidity and then go up maybe tomorrow or maybe a spike reversal. I mostly trade. I've been trying to cut back a little bit on the pairs I trade. Normally, I do trade all these pairs, everything on this list right here. But I've been trying to cut back a little bit. This lately, I've been mostly trading these pairs, just the euro, the pound, Aussie, Kiwi, CAD, Swiss, gold, and then dollar yen, euro yen, and pound yen. But I prefer swing trading. It's just the market's been choppy lately since Trump got office, so day trading has been a little bit better overall. It's hard to swing trade in a choppy market unless you're okay sitting through lots of volatility in your balance up and down. Especially on something like the Aussie dollar. Look at that, this Aussie dollar. Woo! I was thinking the Aussie dollar was going to go down, make a wave Y. I was still thinking that was a good possibility, but that means that the dollar's potentially going to go up for quite a while if that happens. Same thing on the Kiwi. I was thinking that I don't know, the Kiwi just keeps going though. I wouldn't be surprised if this thing just keeps going. Just go down, make a wave five on the 1 hour time frame, and then just keep going. Like I said, if I see a spike reversal, I definitely may take it. So we got about 2 minutes. Get your orders ready if you're trading them. I don't know. Sometimes trading the news is definitely kind of like gambling, but because you can be right about your direction and still get trapped on a liquidity spike. Definitely. So, anyways, let's see. Am I logged into my trading account? All ready to go just in case I want to. Definitely not using a 10 pip stop loss or something during the news if I do get in. Let's see here. Yeah, if you are gonna try it, you're better off using a pretty good sized stop loss. That's for sure. All right, so I'm ready to go if I want to. That's for sure. Yeah, I did the dollar analysis, but we got news in a minute here, so I'm gonna focus on one thing here. Yeah, that's kind of how I feel about it too, CD. I used to always be like 20 seconds before the news came out, I would like try to get in a trade. Like literally seconds before the news, I would try to get in. And every year I do a trade journal, and I look back at my journal, and I realize that yeah, once in a while I was getting like a 4 to 1, 5 to 1 in like 2 minutes, but more often than not, you're getting spiked out by something. Even if you're right about your direction, like I could be right about this, and it still could spike you out at the news. So I used to always do it, but I haven't done it much this year because my trading journal said that it was not a good idea. Like I said, sometimes you get that 5 to 1 in 2 minutes and you feel good, but sometimes you get spiked out in 2 seconds, and then you're right overall. Yeah, exactly, definitely, it's not worth it, is it? So here we go. We got the news coming out. Oh, what's gonna happen? Is it gonna go down one more time? Must not have been a change in interest rates. It's not flying. Any change in rate? No, they didn't change rates. No change in rate. Still 4.5%. Ooh, pretty bullish. More times than not, the first move is a trap. I wonder if this is still an ABC. I was kind of thinking that a few minutes ago. Oh, man. A lot of the times, the first move is a trap, that's for sure, but not always. See, if I was going to get in before the news, I probably would have went short, kept trying to catch a wave five. So, That's definitely not what you want to do. Hmm. Boy, it is definitely spike reversing on the sort of time frames. Hmm. What's it gonna do? This is the 1 minute time frame. Is it gonna hold or is it gonna reverse? My initial thoughts were definitely up dollar, so this could be a liquidity grab. And then the dollar goes up for a couple days and then reverses again, like on Friday or something. Hmm. How many pips was that spike right there? About 30 pips, not too bad. Boy, that's a tough one. Doesn't look like a complete pattern on the solar time frames. I think it's gonna go down, make that wave five. But it's only a wave five, so is it really worth it? If it really is just a wave five, it'll probably just go down, take out these lows, then reverse back up again. I don't know if that's really even worth it. Potentially, you'd have to use like a 30 pip stop or so to make like 40, 50 pips. That's not worth it. I think it's going to go down though. I still think my main analysis is right. It's going to go down. Probably going to trap everybody. Back to the starting line too, by the way. It almost always goes back to the starting line. That's literally where it was right before the news came out. Big old 30 pip move all the way back down to the starting line. Now it's going to start making decisions probably. My overall bias on the euro dollar is definitely up on the higher time phase. The question is, what is the correction over or not? That's why going short, like I think it's going to go down, but it might just be like a 40 pip move and then back up again. So I don't think the risk to reward's really there for me because I would probably have to put my stop loss above the spike. That's like 30 pips, and you potentially would only get maybe 40 pips. So you got to always think about things in risk to reward ratios. With the pound dollar, what happened on gold? Did gold go up too? Wow, gold has been stuck. What has everybody done to gold lately? Whew. I usually don't trade gold that much. I actually had a really good runner on gold to the long side. Um, I think it was this one. Yeah, it was this move all the way up. I like to catch the big swings on gold, but boy, sometimes these gold's something else. Look at that. Ooh wee. Put a channel on there and just trade the highs and lows, I guess, huh? Yeah, gold. I still think there's a good chance this could go up and take out these highs and maybe even take out these highs and then reverse back down. I still think that's what's going to happen. But boy, I can't believe how slow gold has been. Is it because of the tensions between Israel and Iran? Or is there something else? Gold is a safe haven. It's the original safe haven, the OG haven for your money. Obviously, nowadays, crypto and a few other things are safe havens too, but gold has always been the main safe haven, that's for sure. So if there really is like a war, gold often rallies during times like that. So that's potentially why it's been so choppy because most people know that. And if they'd come to an agreement of some sort, then it probably will go down. What's kind of the charts make me think that they will come to an agreement because it looks like a 1, 2, 3 to me. So potentially, I think there's a good chance they will come to an agreement. This is going to be a 1, 2, 3, 4, 5 A B C. 1, 2, 3, 4, 5. So, anyways, now that the news is over, if anybody has any requests, definitely put them in. We keep looking at the same pairs. So, if anybody has a request that they would like me to look at for them, definitely put it in there. I've looked at all the dollar pairs like a ton now, but I mean, if that's all anybody wants to look at, I guess that's fine. Oh, the yield yen spiked reversed a little bit. We're definitely still in an uptrend on yo yen. Yeah, no problem. US dollar CAD, that's fine. I still think that we are not finished with this move up. And because we haven't broken structure on the 1 hour time frame yet, I mean, it tried to just barely, but is that a liquidity grab for the longs or is that going to be a real break of structure? I guess that's kind of what we have to wait for. Doesn't really look like a complete move to the upside on the higher time frames. It really looks like it's still going up. But the market's the only one that knows best. So if it breaks structure, then I'll definitely change it up again. 100%. It looks like it should go to the 61 or 78%. Or possibly this is like a wave A and it just keeps on going up, and this is a wave B and a wave C that does that too. Takes out the high wave 4. That's all. That's been kind of my main analysis is that it's going to go up and take out the high wave 4, which I think would line up with the dollar index analysis, right? Like this would be a wave A, this is like a wave B, then it potentially goes up for a wave C, maybe like the 152 area or something like that, and then maybe down again. I really do not think that dollar index is done, but it definitely could play games with us for a couple of weeks, meaning that it definitely could, go up for a couple of weeks, break structure, probably attract even more buyers when it breaks structure, and then probably down again. US dollar CAD, I mean, I'm pretty, actually, I have a little bit of a different analysis on dollar CAD, but I think we are about to finish either a wave A or a wave 1 on the dollar CAD. It definitely looks like 5 waves down to me. I think that we had the end of a wave B here, and this is either a wave A of a WXY, or this is a wave 1 of a 5 wave impulsive move down, which I think it's a wave 1 because I think this is an A, I think this is a B, which means that it should make a move similar to this move to the downside. But if it's close to the end of a wave 1, it would make sense for it to go up and then down and up and down and up and down. So I think up would make sense for, this is the weekly time frame. And because the market likes to move in Fibonacci sequence numbers, I would probably expect maybe 3 to 5 weeks to the upside, maybe. And then maybe, take out the high wave 4, and then down again. Yeah, I like to, during this news event, I like to wait for Powell to start talking. Now, Powell is going to start talking in 22 minutes. I have the press conference starting. It's starting in 21 minutes and 9 seconds. So I will be taking requests. If it breaks and holds structure, then it probably is going to go down. I'm more than happy to start looking for shorts if it breaks structure, definitely. I'm definitely still on the long side, but the weekly is definitely down. The monthly is definitely down. The daily might just be a pullback to the downtrend. So I'm totally with you if it breaks, 100%. It definitely did break structure, but is that just like a liquidity spike reversal and then it goes up or what? Boy, the yellow dollar is bouncing all over the place. I have it on the 1 minute time frame on my second screen just so I can, just in case there was a spike reversal, I could do an entry, but it's down, up, down, up, down. So I'm probably going to wait for Powell. If Powell does something good, I might try to get in. Definitely don't forget to join my free Discord channel. Like I always say, I mean, I really want to build a community of like-minded traders. I'm not looking to charge anybody unless they want to join my membership, which I'm more than happy to. Even that is only $30 a month. I try to keep everything so extremely cheap because I really just want to build a community of like-minded traders that are willing to help each other out. But if you haven't joined my free Discord channel, definitely do check that out. It is 100% free to join. The link is in the chats. Also, check out my website if you haven't done so. It's fxpipcollector.com. US dollar CAD really looks like it potentially could go down a little and then back up. It almost looks like it's a wave 1, wave 2 to me. Maybe wave 3, wave 4, wave 5 of wave A, honestly, is what I think is going to happen. 1, 2, 3, 4, 5 of A based on that daily time frame that I was just showing you. because this is 5 ways down. We just need to break a structure to confirm that the wave 5 is over. If the wave 5 is over, then that means the whole trend is over. All we need to really see is a break of structure to confirm that the wave 5 is over, and then we'll know that the whole trend is over, and then we would expect to see a pullback to the whole trend, which would also likely take us above the high of wave 4. So that means this potentially would just be a wave A, B, C, or something like that, most likely taking out the high of wave 4 by the time it finishes. Let's see here. I can look at the dollar Poland, PLN. I think I might have it on here. Yeah, I do. Definitely a pair that I don't keep up with. Actually, this is my original. I've been changing my charts over to from white to blue. So this is my original charts. White, I like the white better because I'm colorblind. I'm very colorblind. But when you watch your charts a lot throughout the day, a white chart will definitely give you a headache. A black chart is way easier on your eyes. So that's the only problem with that. I might have a little analysis on this though, because I still haven't switched everything. I don't really have much on there. This is the monthly time frame, and I know you probably don't you want to see a sort of time frame, but you always start at the top and work your way down if you're doing any kind of analysis on any kind of pair. You need to do a top-down analysis, even if you're trading a 1 minute time frame. You could be trading a 15-second time frame, and I still think you need to do a full top-down analysis. Definitely. It's important. Very, very important. Let me just throw a couple things on here. Yeah, that's definitely overextended, but that's definitely what I think it is, though. Let's see here. Where are we at on the fib levels? Ooh, almost at 161. So my main target would probably be the 161, 178 area right here. The news was the FOMC, which just came out, but now we're waiting for Powell to start talking, which is in about 14, 15 minutes, 16 minutes. When Powell starts talking, the market could possibly make a decent move for sure. I think we're still going down, and it possibly could turn into an expanding, and if it's an expanding, it would go all the way down here. Probably more likely not an expanding. It's probably more likely like going to go to this area. Probably to 161, 178, double bottom or something like that, and probably back up again. So I know that's a high time frame, but that definitely tells you what to do in the sort of time frames. That means anything I see to the upside on the daily is probably just a pullback to the downtrend. The last impulsive move down on the daily starts right here. So that's where you'd want to put your Fibonacci level. Actually, I prefer not to have all those extra levels on my retracement. Like that. Then take it down to the 4 hour. So the last impulsive down on the daily was this. So unless you get a break of structure of this 100%, you kind of need to assume that anything you see to the upside is nothing more than a pullback to the downtrend. So it's definitely going up. So now it becomes what time frame are you trading? Are you trading below the 1 hour time frame? If you're trading below the 1 hour time frame, I'd definitely be recommending longs. If you're trading above, like the 4 hour, if you're kind of a swing trader, then I'd probably be waiting for a Fibonacci bounce, maybe in the 61% area, probably to go long. You could potentially go long for this, and then potentially go short for that. Probably an ABC in here somewhere, I bet. Especially looking at the dollar index, I bet that is an ABC. So that's what I would expect on that. So yeah, let's see. Pound Aussie. I haven't been keeping up, like I said, with all the pairs. Longer term, I mean, it's probably going to go up it's probably not going to be real long term though. It's probably going to go up for a day or few days, and then it's probably going to go down again to that 100% Fibonacci, maybe even lower. Not 100%, but 161% on the weekly. 3.5, maybe 3.325. So yeah, definitely working on that. So anyways, yeah, definitely, no problem. Some of these pairs, like I said, I haven't been keeping up with because I'm switching from black charts to white charts. So to do the pound Aussie, I got to go back to the white chart. And to be honest with you, I haven't been looking at it regularly because I'm switching over my charts. But I still think it's drifting up, at least for now. It looks to me like we're starting a wave C, to be honest with you. I mean, it totally, oh, I guess it's back to blue so you can see. Totally looks like a wave A, a wave B, and potentially down for a wave C, or potentially a wave 1, wave 2, wave 3 on the weekly time frame. Then you bring it down to the daily, and you're like, okay, well, like I said, I haven't been keeping up with it because I've been switching over my charts, and I mainly trade the dollar and the yen pairs. But I think there's an ABC in here somewhere. I think there's 5 ways down that I just deleted as the A. This is like a regular or running A, B, C, or B. We're probably going down for a wave C right now. It's probably going to go down to a Fibonacci retracement on this last 5 waves up, and then potentially continue the uptrend. You day sinking? Nice. I'm still watching the euro dollar. I definitely don't see that doing much. And the US dollar yen, I mean, it made a push down, but it definitely isn't sinking anymore. Pulled back a lot. Euro dollar. Like I said, I was watching the euro dollar on my one of my second screens. I have 4 monitors, so I've been watching it on my other monitor because this has been usually my main pair. And it made a big move at the news, but ever since that, it's been up and down, up and down. So we kind of got to wait for Powell to start talking to see what he says. Depending on what he says, it's going to depend a lot on what's going to happen. Because if he comes right out and says, "Oh, we're probably going to change interest twice this year if everything goes as planned," or maybe he's going to say, "Oh, we're worried about a war, we're worried about inflation, so we likely are not going to change interest rates this year," or something like that, it's going to make a big difference. It kind of still see. Oh yeah, I can do the pound yen. I haven't looked at that. It still kind of seems to me like the euro dollar might go down, but my overall bias is up on every single higher time frame, so I have a hard time sorting it. I feel like even if it does go down, it potentially is just a wave 5 of wave C, maybe. That's definitely what it looks like. It looks like a perfect pattern. But so before the news came out, I said it almost looks too perfect. It looks like 5 waves down for A, looks like 3 waves up for B, and it looks like 5 waves down for C. It looks like a perfect 3-5-3 pattern in Elliott wave terms. So we'll see if it plays out like you said. It should go down, finish the wave 5, and then it should go back up. So down and up potentially would be. It is time to break structure. I will give you that. Boy, if that US dollar yen goes up and breaks this structure, I would go long. But then I was just saying that the euro dollar might spike reverse. So I mean, this potentially can do the same. Maybe it goes out, breaks the structure, goes up for a day or so, takes out this high, and then reverses back down, breaks this structure, and then continues the downtrend. Honestly, that might be the more likely scenario. Pound yen. Ooh, pound yen. The pound, I think, is leading a little bit over the euro yen and some of the other yen pairs. I think we are in a wave Y right now of a WXY, and I think it might be close to turning if it's not already. It's a WXY on the daily. If that's true, then this could be getting ready to make a B, C of B, right? Because this would be your A, and I know it's kind of hard to see, especially for people that don't do Elliott wave, but this potentially would be your A, and then you have an ABC of B, and then potentially it would go back up for a wave C to match this wave A over here. So this could be like your pink wave C, pink wave A to match, and then potentially this move down right here would match this move down right here, and potentially this move up matches this move up, and this move down matches this move down. The market is just one big old never-ending pattern of cycles. So it seems like it could be going down overall. I would be looking for shorts on pullbacks, definitely. On the pound yen too. I'm sorry, I was looking at the euro yen, but Same thing except for the pound yen's, I think, leading the way. I think this is a WXY. I think it could be a wave A, B, and then go up for wave C, just like I showed on the other one. Yo yen and pound yen are usually doing very similar things. It's just usually one's a little stronger than the other. I think this could go down to this low someplace, make that, and potentially do something like that, and then probably down again. Probably gonna get an ABC of B, ABC of Y, which is an ABC of B, something like that. I would say. Boy, that yo dollar is not doing anything. Dollar pairs are definitely waiting for Powell. That's for sure. 100% waiting for Powell. Powell could move the market. We got about 9 minutes until he comes. 8 minutes until Powell starts. I don't think he's really given too many speeches since he had that meeting with Donald Trump a few weeks ago. He most of the time a president will meet with the I'm sorry, the Fed chair almost right away, but Trump didn't meet with him for quite a while because obviously they didn't get along very well. And they finally met like a week or two ago. And ever since then, I haven't really. I don't think he's done much for speeches or anything since then. So I bet this is going to be an interesting speech. One of the last speeches I watched for Jay Powell was at the college or whatever, and he literally spoke for like 2.5 minutes, and that was it. He was done. No questions, no nothing. He just walked right off. Euro pound is another one I would have to switch back to my white charts because I haven't converted it over. But yeah, I haven't been keeping up with this pair because I mostly trade the dollar and yen pairs. But I am going to work on it. But probably by next week, I'm going to have everything on this list at least analyzed on the daily, weekly, monthly. And I prefer to swing trade anyways. And if the market's going to be trending, I prefer swing trading all day long. If the market's not trending, obviously you got to do more day trading. But in a trendy market, I prefer to hold on for the big rides, big risk to reward trades if you can. I was thinking that overall this was going to keep going up, but oh man, it probably is going to keep going up. I bet that's what it's going to do. A little hard to see the yellow. Sorry, I keep switching from black to white charts. I'd bet it's going to do something like this. And that's the weekly, that's the monthly time frame, but that should potentially tell us what to do on the daily. Maybe it's not an A B, maybe it's a 1-2 of A. Honestly, it'd probably make more sense if that's what it was. So I would definitely have my Fibonacci retracement on this whole move down because these Fibonacci areas are definitely going to be areas of resistance in this move up. But the daily is pretty heavily up, and we're not in the business to really get into exact tops and bottoms. If anybody has listened to any of the Market Wizard books, which if you're a trader and you haven't, then you're definitely missing out. Uh, the best traders in the world don't try to identify the exact tops and bottoms. But somehow retail traders think they need to identify the tops and bottoms exactly, which gets us in a lot of trouble, definitely. I think it's still going up, but at some point it could start a pullback, which would be good because then we could go long again. But yeah, once it finishes the 5 waves, it's probably going to make an ABC crescent to the whole 5 waves up. Maybe something like this. And then probably up again. Maybe this top right here will become a bottom. Something like that, maybe. Tops become bottoms, bottoms become tops. And like I said, I've been watching the euro dollar on the 1 minute time frame on my second screen, and the dollar pairs made a big move, and they've literally done nothing ever since then. They're waiting for Powell. Up, down, up, down, up, down. Powell is probably going to get these things moving a little bit, I bet. Yeah, look at the pound dollar, same thing. Except for the pound dollar is bouncing around the starting line. This is where the market was before the news came out. My original analysis in my videos and before the news came out is still what I think is going to happen. I still think it's going to go down, take out these lows, then possibly back up again. But we'll see. Yeah, Bitcoin. I've kind of looked at Bitcoin a couple times, but I think at some point, maybe tomorrow or maybe tonight or something, it's going to start a move to the upside. I think it's going to go up. I don't really think this is a wave three like we were talking about in my group the other day because it's not impulsive enough. I think it's going to go up again. I think it's correcting. I think it's going to go all the way back up to 110, 112,000, and then maybe down in a big way. Not a real big way, but maybe down to like 95 or something for wave C. That's a pretty big way in the Bitcoin community, probably. That's probably a pretty big percentage, isn't it? If it went all the way up here and then went all the way down there, uh, about 14% maybe, 13 and a half. Pretty big drop. But we'll see. I mean, it's definitely an uptrend on every single time frame, so we'll see if that's how it plays out or not. But boy, it definitely looks like a wave A. It looks like a wave B. Looks like it's going to go down, make a wave C. Probably take out some of these structures. This rally-based rally right here may become a support area for the next move up. That's my predictions, definitely. I'm not a crypto guy. I've never traded crypto in my life. I own a tiny bit of crypto just because when I signed up for a treasury account through this brokerage, they gave me a little bit of Bitcoin a couple years ago, and now it's worth like a few $100s, like $500 or something. So that's the only Bitcoin I have ever had in my life. I've never traded crypto in my life. My broker does offer it now, though, so I could trade it if I wanted to. So we got a couple minutes until Powell comes out, and then we can listen to see what he has to say. I'm interested to hear what he has to say, definitely. Draw in his face a little bit. We should get the charts set up and ready to go, huh? So let's see here. Like I said, if you haven't done so already, definitely do check out my Discord channel. It is 100% free to join. I will never charge you. I do offer a $30 membership, but the Discord channel itself is 100% free. You never do have to pay a dime ever. So definitely check that out. The more you participate in the chats, the better the community is. So definitely don't be afraid to say your charts and stuff like that. Say your analysis. Sharing is definitely caring when it comes to trading. The more minds we have on a pattern, the better off we are. Definitely as a group for sure. So definitely check that out if you haven't done so already. It is 100% free to join. If you watch the video on my homepage, this is my website right here. It's fxcollector.com. If you watch the video on my homepage, it walks you through literally everything. Right here, there's a video. It's 8-minute video. It literally walks you through everything that is offered on my Discord channel. Most of the benefits are on Discord. It's just the Discord channels are locked for most people. So if you pay for the membership, all these other channels right here are all unlocked. Everything where it says members channels down. If you join my Discord channel, there's a public area that's 100% free for everybody, but all these are free. Every single day, I do a members forecast for all these pairs every single morning, right in the London session. And then I do a Zoom meeting twice a week. But yeah, definitely check out that video. It'll explain everything. And like I said, I keep my membership very, very cheap because I'm not looking to get rich from my membership. I'm looking to get rich from my trading, definitely. But for me, the group is just as beneficial as it is for you guys because when it comes to trading, having more minds on something is better. The more people you have that work together to try to figure these things out, definitely, the better off you are. So I do share every single trade I take with my members at the time of entry, but the people that do best are definitely the ones that learn and analyze and take their own trades, definitely, 100%. So let's get the charts queued up correctly here. Do that, do that. Is this the right one, right? Oops. We gotta get Pal ready so we can watch and see what he has to say. Get the charts ready so we can still keep an eye on them. Pal should be coming out any minute here. Can I make this full screen even though? Like a half a screen thing going on. Oh yeah, that just messed me up. That ain't gonna work. Oh, here he comes. All right, I'm gonna make it so you guys can listen to this. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year
are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith of the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment, things like that, that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effective tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that, and our job is to make sure. One of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjust it over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of Reuters' short-term neutral rate? Is it why are you on a slower path?
So I would focus most on the nearer term as you get out to the later years. It's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April after the March meeting that substantially higher tariffs were likely, and then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time, and what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that they do. So and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that. No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber, Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see whether, to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point, it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? Could you share that?
Yeah, what you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff, but together they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict, and we haven't been through a situation like this, and I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data, and again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamros of the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. And this is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things, and I think as the data come in, you should see those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-throughs, price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction. And I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers about the outlook for the economy.
Okay. From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Thanks, Mr. Chairman. I guess with workplace raids increasing, picking up significantly, what kind of effect would that have on the labor market?
Sorry, is what picking up?
Workplace raids.
So you're asking immigration?
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of, how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation. Number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decisions based on data instead of speculation. You said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today and you didn't cut today?
Well, the forecast for inflation in December was 2.5%. Core PCE for 2025, the forecast was 2.5%, which is a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be. We've learned that tariffs are going to be substantially larger than forecasters generally thought, and we don't. Our forecasts are generally not particularly different from those of other, well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming, and that would mean higher inflation. That's what happened, and so now you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans, small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. The best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis, that, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high. Let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now, and inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting a pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs, because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind, or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say. That's what the data say from past FPC. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
Follow up on that. So you spent years ago talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again. Right, so it's always forward looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward looking because we knew things were going to be unusually difficult. So of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this and they understand how they're going to go. And it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Thank you. Amara Mokway with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said, no, and I sort of said as a pun, overworked, but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we work hard. But I would say this, so we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're gonna show the public. We're gonna demonstrate that we are good stewards of public resources. So we thought, and I thought that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're gonna find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it again respecting that we have critical missions to carry out. I've had a lot of experience in my prior careers, with headcount reductions and things like that. And this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions. And I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and the effects will be at the margin. I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil.
Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks. Worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see, layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there's a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult. And it's so important that we get it right. I just would say it's not a place I would want to keep investing in that, for the good of the general public.
Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair. And I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that a new chair might want to come in and go in a completely different direction. I really don't think that's right. But that's not going to be up to me to decide.
Is that affecting at all who you're consulting with?
Not at all. Not in any way.
Thank you. Chair Powell, Matt Egan from CNN. Relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation? And what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did, because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I just got to ask you about artificial intelligence. Some technology executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. Question really is, will AI be more augmenting labor or replacing labor? And I wouldn't. We all see those announcements, including one today. I wouldn't, overread a couple of data points, because AI should be creating jobs at the same time. It may be replacing, maybe doing both. Anyone who's done any work with AI will have been a little bit stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. You know, they say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. You know, of course, there are optimists who feel like it's going to make everybody much more, much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Thank you. Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the dollar movements of the dollar was impacting the economy. Are we going through something like that now? That are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint, you see this not just here but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. I mean, and it doesn't change our objectives or what we need to do. And these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. Will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know though. So, but you're right. But honestly, our focus is a much more practical one, and that is how do we keep inflation low and employment high in the near term. That's really what we're about.
Mark.
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack really. I mean, at the margin, remember you're at 4.2% unemployment. That was for many years, that was an extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but those are good numbers. So it's a pretty good labor market. There's a more concerning thing is there are not a lot of layoffs, but there are not a lot of job creation. If you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's an equilibrium we watch very carefully, because if there were to be significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. the U.S. economy has defied all kinds of forecasts for it to weaken really over the last 3 years. And it's been remarkable to see just again and again when people think it's going to weaken. Now, eventually it will, but we don't see signs of that now.
Go to Jean for the last question. Hi, Chair Powell. Jean Young with MNI Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's a lot of there's some skepticism over whether those price hikes will be a one-time event.
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So I think, people are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, it's think of it as the least unlikely path in a situation like this where uncertainty is very high. I think again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to do that with confidence. So I would just say it that way. We don't rule things in or out. Certainly a hike is not the base case at all. It's not something people are writing down. But in the meantime, we do the best we can with these forecasts, and I think they're representative of the different forecasts and different reaction functions that people on the committee have. So thank you very much. Thanks.
Okay, it is over. Powell has finished. So let me just make this full screen again. Let's see there. So I'll go through the dollar pairs one more time. If you haven't done so, definitely do check out my free Discord channel. It is 100% free to join. Definitely do check that out. And yeah, I'll go through the dollar pairs one more time. We have a lot of news this week also. I was looking at during the live stream. We also have some really important Aussie news this evening, as you can see. And then tomorrow we got the Swiss interest rate, which they do plan on lowering interest rates 25 basis points. Also tomorrow we have the UK doing their interest rates, which they do not plan on lowering, but if they do, that could be a big surprise to the market. Technically, Thursday is a bank holiday for the US, but it's not that big of a holiday, so it shouldn't be too bad. Should be plenty of volatility still, I would think. And then on Friday, we got a few things going on, but this Bank of Japan thing is kind of interesting because they don't normally speak too often, so that could possibly be something good too. So definitely a few things to look out for this week. Now, like I said, I'll go through the dollar pairs one more time. I definitely think that this is pretty likely going to be. Let's give me 1 second here because I got a couple screens going. I think that the euro dollar is telling the story big time. Definitely looks like it is at least. Let's see here. Just keeping an eye on things. So to me, it really looks like a very clear 5 ways down for wave A. Let me switch to yellow. You can see it easier. And then it looks like a very clear 3 waves up for B, and it looks like another very clear 1, 2, 3, 4, 5 waves down for the wave C. You saw me put my Fibonacci extension on here because the 100% is a likely target for wave 5, 100% of wave 1, projection off wave 4. And plus your Fibonacci retracement is also a good indication, which we're sitting at the 61%. So a couple good, pretty significant areas of support, definitely. So I think there's a good chance we might get a reversal. If it really is an ABC, it should take out the previous highs. So we'll see if that's what it does or not. Now the pound dollar is definitely quite a bit different, but I was talking about this I think today in my video or something, which is that this is actually 5 ways down. This is potentially 1, 2, 3 waves up, and this is potentially 5 waves down. This could actually be a big ABC correction right here. We could possibly get a pretty significant reversal maybe tomorrow at the pound interest rate, or maybe it'll start tonight during the Asian session, but we have pound news tomorrow, so that's pretty significant. The Aussie dollar, to tell you the truth, the Aussie dollar actually has me pretty thinking that it could become pretty bearish just because there's possible WXY analysis, but it could potentially just go down, take out this, and then just keep on going up from there. Definitely very bullish on all the higher time frames. So I think there could be a little bit of short-term movement to the downside, but overall, definitely still very bullish. Same thing on the Kiwi dollar. There could be a little bit more down, but overall, I think we need to stay pretty bullish. US dollar CAD, I mean, this is actually something that looks like it could potentially make a bigger turn, to tell you the truth. If we get a break of structure, that potentially is going to be a pretty significant turn. That would potentially be the end of this whole move down on the daily time frame, wave 1 or wave A, which would take you above the higher wave 4, almost definitely. So, pretty significant possible turn if we get this break of structure, which it looks like we could. US dollar Swiss is also potentially getting ready to break structure. And let's see if it does or not, but if it does break structure up, it's probably the end of a five-way pattern on the daily time frame, which will take us above the high wave 4, probably to a Fibonacci retracement of this whole move down. So definitely got to keep an eye out for that. We could be possibly close to some big turns. US dollar yen to me is a little bit different, but I don't know. On the sort of time frames, it definitely looks like it wants to tank down. It definitely looks like impulsive. It definitely looks like very corrective. It definitely looks like it potentially is going to go down for either a 1, 2, 3 and just keep on going, or possibly an A, B, C like this, and maybe make a little bit of a higher low and then go up for the bigger A, B, C. That might be pretty likely too, but something along those lines I think is very likely. And gold, I think, has been quite the nightmare, to be honest with you, but I've actually got a bearish bias. I was thinking it was going to go up and do a liquidity grab today. I thought for sure it was going to make like there was a wave A, B, C in here for like a wave 2, and this is a wave 1, and then potentially down for a wave 3 is what I thought was going to happen. But my overall bias is bearish, so there is a chance it just keeps on going down. You know, it might have just made like a very small wave 2, potentially make a wave 3, probably ending down here somewhere, wave 4, wave 5. So I think that's pretty likely on gold. I will be doing my PM video, so definitely keep an eye out for that. I do live stream during these FOMC meetings, so definitely make sure you like and subscribe if you haven't done so already. Makes a big difference to my channel. And as always, check out my daily forecast videos. If you want to see my schedule, you can join my free Discord channel, which it is 100% free to join. You do not ever have to pay a dime. The link for those in the chats and in the description of the video. But my video schedule is on there, and my live stream schedule and all that stuff is on there. Also, check out my website if you haven't done so already, fxpipcollector.com. And there is a short video on the homepage of that website that you can watch, an 8-minute video right here that you can watch, and it explains everything. I keep my membership very cheap because I'm not looking to make a fortune for my memberships. I'm looking to run a free Discord community more than anything and make a fortune for my trading. So definitely check that out. Anyways, I will talk to everybody later. And as always, thank you for watching and happy trading.